While the word yield has 5 letters, it's largely become a 4-letter word in the world of crypto. Obviously, after the Luna Anchor UST collapse last year, and then, of course, the massive collapse and contagion in the centralized finance CeFi world. But I think that we're largely throwing out the baby with the bathwater, and there are still wonderful and relatively safe opportunities in DeFi. Every time I want to talk about DeFi, I seem to get together with my friend Philipp Zimmerer, who I have here today from Spool. We're going to discuss whether there is still safe yield in DeFi, how that is the case, where you can find it, and of course, how you can look for red flags in the cases where it is absolutely not safe so that we can all move forward with the good products and throw out the bad. We're going to start right now. Let's go.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of All Streets. Before we get started, please subscribe to the channel and hit the like button. Frankly, I have no idea why we still say that. It's just become so habitual that it doesn't move the needle. You're the same people. It's wonderful to have you guys here, but I'm assuming that you're all pretty much subscribed. And then does that mean that if I ask you to hit the subscribe button that you're going to hit it and it's actually going to unsubscribe you? Never thought about that. Never thought about that. And what if you've already hit the like button and then I ask you to hit it again? Is that going to unlike the video? I don't know. Seems like a logistical nightmare, to be quite frank. So maybe just avoid all the buttons and listen. So guys, yeah, listen, mention this and nothing's set in stone yet, and got some pushback from some of you guys, specifically in the audience. But before I bring on Philip, I did tweet yesterday that we're going to be making a pretty big move from YouTube to Twitter Spaces. That does not mean that we're giving up on YouTube, of course, but I've sort of found over the past few months, years, decades, I don't know, I've been alive a long time, that where I excel and what I enjoy the most and what you guys engage with the most is the roundtable and long form conversations and interviews like the ones I have today. And that unless I'm going to do this on my thumbnails, for those listening, that was me making a stupid face. Unless I'm going to do this in my thumbnails, tell you guys what the next 1000x altcoin gem is, and aggressively show myself trading 1-minute charts, probably not going to really ever work out on YouTube. So I'm going to go, I think, back to the basics, the things that we're better at, and Twitter Spaces seems to be a better platform for those conversations to some degree because we can roll the guests and because, frankly, I have 875,000 followers here and 125,000. I see Drusified asking, does Twitter have space video? No video. But we're going to obviously continue doing like Macro Mondays and the Thursday roundtables, which have been very popular here. So now that we got that out of the way, and you also notice no sponsor, Prime XBT gone. So boy, bye. And moving on, I'm going to bring on Phil right now, and we're going to talk about yields in DeFi. Phil, how are you, man?
I'm great. Thanks for having me. And
well, you haven't slept in a week, right?
Yeah, I mean, I've slept tonight, right? Last night was pretty good. But before that, we had a big launch, as you know, and I get anxious, I just don't want anything to go wrong. You know how it is in DeFi. One mistake and people's funds are at risk, so got to be on the ball.
Yeah, so listen, obviously, I'm going to let you talk about Spool, but we're going to talk a little bit more generally. I just want to give you and I have talked, this got to be the third or fourth time, but to give the disclaimer, I was a part of the pre-DAO for Spool. I was the only DAO I've ever been involved in. Really interesting thought experience for me, for sure. And I do hold Spool tokens, which are staked and will be forever. I have no intention of anything, but I like to tell people that this is actually something that I care about and feel passionate about and been a part of for a very, very long time. But let's just start from the beginning. Listen, so I gave the intro disaster last year, right?
Yeah.
We had the CeFi collapses, of course, the risk-free 20% UST yield. So how do we offer safe yield right now in DeFi, and how can people believe that these safe yields exist?
I mean, look, there is no such thing as safe yield ever. Maybe the closest you can get to is like the risk-free rate, which you would probably equate to US treasuries, right? Like if the US government starts defaulting on their debt, that will probably be a pretty big calamity. But there is no risk-free yields, right? People, you're earning yield because your capital is doing something. It's being productive, right? And at the very least, you always have an opportunity cost attached to it, right? That being said, in DeFi specifically, I think the safest yield is the one that you understand. So you know what your capital is being used for and where those dollars that you're getting or that yield that you're getting is actually coming from, right? So the best you can do to identify safe yields is understanding the source of the yield, be it like someone paying you interest for borrowing your funds, or someone taking advantage of your liquidity so they can execute trades at a better rate and paying you fees for that, right? Or someone giving you governance tokens for providing liquidity elsewhere, which you can then sell and convert to real money, right?
So the question obviously in the title is there still safe yield in DeFi? So I guess it's all relative, right? And so it's actually about risk managed or risk awareness. And then the individual actually having all of the information and transparency from wherever they're getting their yield, and then it's up to them.
Look, I think if someone promises you returns with no downsides or asterisks, right? I think that's usually snake oil, right? And you're probably the yield in that case. So be aware of that, right? I think there is plenty of safe yield in DeFi in terms of you're actually able to identify the risks, right? Like you said, it's relative. So it goes beyond stablecoin yields, right? Stablecoin yields, especially on mainnet, are somewhat depressed. I think, as you've already mentioned, we've already talked about this, right? Treasury yields are what we're currently competing with, and we're finding yields at or below that level. So it's pretty tough. So people have to look elsewhere for yields. And the good news is there is still relatively safe yield that might expose you to some volatility unless you're employing certain hedges, right? So the big narrative right now is real yield, right? And that's safe to the context that you know exactly where the yield is coming from. And real yield is usually yield that is based on people using a service or utilizing liquidity and willing to pay for it in fees. So that yield is not derived from inflation or anything similar to that. It's actual revenue. And it's basically similar to holding a share in a company for all intents and purposes that's paying you a dividend. So GMX would be a prime example for that. People are using GMX to leverage trade and also to a degree for swapping. And staking the token gives you a share of the fees that they're paying for it. And similarly, you would have GLP, right, which is also another example of that, where you're essentially exposed to a basket of assets, right? That's not entirely delta neutral, but consisting of, I think, right now around 50% of stablecoins. The rest is in blue chips like BTC, ETH, and some smaller positions in alts like Uni or Link. And that's essentially a yield basket that acts as the counterparty to the traders on GMX, right? So you're essentially funding the P&L through that GLP basket, right? And that means you're exposed somewhat to the price movements of the underlying assets, right, that are in the basket, but also you're exposed to the P&L of traders. So if traders lose, then the GLP holders win and vice versa. So that's some risk that's attached to that. So GMX is paying a higher amount of yield for that, right? So you're getting, I think, 70% of fees for that. So that's real yield as well, because again, you're providing the liquidity to fund traders' P&L, and in exchange, you're getting the fees that they're paying to trade.
So you want them to lose?
Yeah, I would like them to lose as a passive provider, right? But the point is, this is something really, really cool, right? Because there's like a lot of people that always wanted to be the casino, and to an extent, this allows you to be the casino. And there's a lot of like, I don't want to be specific to GMX. I think it's just one of the examples that people know best, right? But there's other platforms.
The house always wins,
there, right?
so
Yeah.
It's an opportunity to be the house. I get that.
Yeah,
absolutely. And so, what in a model like that, you know, are there unseen risks that maybe people aren't thinking about. You talked about obviously the volatility of the basket. I mean, we saw that when something was pegged to Luna, obviously, and Luna goes down 99% in a week,
it's very, very different to Luna, right? Like with Luna, I think the problem was that UST kept paying you yield, right? 20%, no questions asked, and this scaled infinitely, right? With the funds in there, because it was fed through rewards, through a reward pool that kept paying you out this 20%. So at some point, I think you had like 16 billion UST, right? So if you do the math, that's through $3.2 billion that you're giving out in stable coins. Where is that coming from, right? Ultimately. And yeah, this is part of what, obviously there's much more to the collapse than that, right? But like this $3.2 billion wasn't really the cause of any real revenue or real economic activity that was underlying there, right? In the case of real yield, like as the basket grows, if the underlying activity of traders doesn't increase, then your yields will shrink, right? Because the traders that trade a certain amount, right, and pay a certain amount in fees will get split up over a larger amount of assets in the pool, right? And this is also how like a stock would work, right? A dividend stock, right? If it pays 10% dividends and the underlying like value of the stock would double, right? Then that would be the same absolute amount if the dividend is the same absolute amount. But since the stock is worth double, that would halve your effective yield, which I guess you wouldn't mind if you bought before the price doubled.
Sure, exactly. And are there other unseen risks? Obviously, we've heard about exploits, hacks, wormholes, bridges, all these things. So how can somebody price that in when putting money into, any sort of pool or investment in DeFi?
I mean, there's always smart contract risks, right? So that's the second part to understanding risk. And I think this is a little bit more difficult for people because it's very, very hard to assess smart contract risks. I mean, even professional auditors, like you've seen plenty of audited smart contracts and protocols getting exploited.
Everything that gets exploited has been audited by all of the big auditing firms, of course.
Like that's literal professionals looking at smart contracts saying, yeah, fam, I think we're good. And then turns out we're not good at all, right? We're getting exploited. So that's always something you need to be aware of. Smart contract risk. Also, sometimes you're depositing into like a yield aggregator or an auto compounder that then redeposits your assets elsewhere, where you're not even like it's not even the primary contract you deposited in, right? It just gets passed forward into the next smart contract, and yeah. So you have to look at the layers.
Yeah, it makes perfect sense. So I think the bottom line is that if you're able to at least assess some of the risk, that you're then able to make an educated decision on what you're willing to do as an investor, which was not the case with any of the CeFi collapses last year. Yeah, right. So I've always made the point, and a lot of people have come on and said that quietly DeFi was the winner of everything that happened in 2022.
Absolutely. I mean, obviously, media would have you sometimes believe otherwise because it's a much cooler story to tell everyone. Oh, like a lot of people like to see crypto fail, right? We know that, right? So it's a nice story to tell people, oh, DeFi failed, DeFi's poster child, yada yada, and then throwing in like centralized entities like Celsius into the mix. But actual real blue chip DeFi stood tall, right? There was nothing really bad happening. I think the worst I can think of was some like bad debt on, for example, Aave, when like the curve position, like Michael's curve position, Michael from Curves, like position got attacked recently, things like that, I mean, that's basically blue chip DeFi was standing tall, right? Like all you have to deal with is in the end, like new protocols coming, and then the smart contract risk that you're facing. And you can just read rect news. It happens every other week. So DeFi as a whole is not safe, right? Unless you know what you're doing and you're assessing properly, and you can actually understand the risk that you're taking.
I mean, interestingly, even with all of Celsius's problems, which was obviously centralized finance, they paid back their DeFi loans relatively immediately, even in the midst of all of the nonsense.
Because it makes economic sense for them to do so, right? All of their loans there are over collateralized, right? So them getting liquidated means that the people that they were borrowing from would still be made whole, but they would be out of like the liquidation premium, right? So even if you're in financial distress, an over collateralized lending platform is still the first party that you would want to pay back, right? Because it just makes, like, defaulting on it doesn't do you any good because you have collateral locked up there. That's the power of smart contracts.
Yeah, that's another part of the story that quietly, obviously, has not really been told, but it's very, very telling to me that that was a fact. You just said something right before that that was interesting as well, talking about people being able to identify the risk and understanding what's happening in DeFi, that maybe, though, it takes a certain amount of savvy and knowledge to participate in this. So that keeps, I think, the audience still very crypto native and small. Is there a time in your mind, or is it a UX UI issue, where we can go very mainstream with DeFi and your average person can click a button and participate in this without really understanding smart contracts or wallets and all those things?
Of course. I mean, we spoke about this 1.5 years ago already, I think, for the first time.
Yes.
And then since then, I think we've been super early with this, right? Maybe a little bit too early even. But what we need for DeFi to really become mainstream is we need to have financial services that allow people to, well, invest more responsibly, get a professional's help. I mean, I compared this yesterday in a talk I gave on our Discord, right? Like, in real life, you don't have people going directly to market makers and saying, hey, can you like market make with my funds and like monetize the spread for me? Or they're not going directly and giving out loans. Well, at least not the majority. The majority of loans are given out by banks, right? By middlemen that is loaning out your deposits to people that need it, right? Nobody's doing that directly. That's financial services. And we need that in DeFi as well. We need financial services that are built on real yield created by DeFi, right? That's what we need for DeFi to go mainstream, because that's what's ultimately going to allow retail investors to start depositing funds into these financial services that then know exactly where these funds need to go and where they're most efficient in terms of risk-adjusted yield, right? Because 1,000% yield doesn't help you if after 10 days you get rug pulled, because then your effective yield is 0, right? That's risk-adjusted yield, right? So a 4% yield that is safe is better than 1,000% APY that gets you rugged.
Yeah, absolutely. So let's talk more specifically about Spool and how you guys are approaching this.
Yeah, so I mean, like, these financial services that need to be built, right? They require infrastructure, because if you're building out a financial service, let's say you're trying to build like an app, or you're an asset manager, you're trying to build like a yield ETF, right? That it's like a lending ETF, right? If you were to build that right now, you would have to tap into every protocol out there individually. This means that you would need to essentially code adapters for every single strategy and every underlying yield primitive out there that essentially allows you to handle whatever strategy generates your yield, right? Sometimes that would involve depositing and claiming tokens and compounding these tokens. Other times it's a more passive strategy. Sometimes it would require active management, right, for positions like on Uniswap V3. There's a lot of strategies out there that all require different handling, and therefore would require individual adapters that allow you to tap into those, right? So that's not very efficient, because you actually want to focus on building a strategy for your financial service. And then what actually generates money for you is, or generates income for you, is to onboard capital, right? Go out there, find investors, find people that want to follow your strategy. And you would ideally have like an infrastructure that you're building your financial product on. Because the cool thing about DeFi is capital can be reallocated at a whim to wherever it's most efficient, right? So if you have like no transaction costs, like is the case on many on L2s, or barely any transaction costs, it would even be smart to sometimes swap positions, rebalance between positions multiple times a day. You don't want to manage that automatically, because this is DeFi, right? We can build smart contracts for that. We can build infrastructure for that automates all of this. And this is precisely what middleware is, right? And that's what I think we're going to enter at some point as DeFi becomes more complex and we get more real yield options. nobody wants to grind every single day and manage their own yield portfolio. People want to automate that, and that's when they're going to be looking for infrastructure that does that for them. And that's what I think is going to be the middleware narrative that's coming up, right? Of automating these yields and building products that are able to go mainstream with very simple UIs, automated, risk managed, that people can very simply deposit into, right?
So you talk about obviously building financial services. What else outside of Spool, which we'll come back to, like what else do you think we need to see built and working? Insurance. I mean, to me, that's a glaring hole in DeFi at the moment. I know there's a lot of people working on it.
Yeah, insurance is really, really hard to figure out, right? Because it's so binary. Like DeFi is so binary. You earn yield, you insure your yield, and then usually when something gets exploited, it's for the full amount, right? So how do you price insurance premiums in such a binary risk market, right? Either nothing, like if you think about it, you could launch an insurance today and just like offer insurance for what you think is fine, and then just hope it's fine forever, collect the premiums, and then as soon as it blows up, how are you ever going to pay people out? Like you're never going to pay them out from the few premiums that you collected unless you charge massive premiums, in which case you're eating up all of the yield, right? So that's a very, very difficult thing to solve. So I think that we still have a ways to go there. And if there's like someone listening to this who has it figured out, please contact me. I want to help you, and I want to learn about you, and I want to implement you, because yeah, it's difficult. There is obviously some insurances that do work, that do pay out, right? But if there's a major collapse, it's super hard. Like if there's billions lost, like what insurance, what DeFi insurance has billions of dollars ready to pay out people that get affected? None of them. It's so hard, right? So yeah, it's difficult for sure. But another thing that can get worked out is compliance, right? Like the eyes are on the US right now. So in the US, we're all looking what Gary Gensler is doing, and what is the SEC doing, what's happening with stable coins, what's happening with Coinbase, all eyes on that. But I'm European, right? I'm German. So I have my eyes on the European market. And especially with Spool, we're doing a lot of business development with institutions and with people in the real world, having our ears to the ground. And crypto is actually getting regulated in the EU. This is one of the things that is not talked about a lot, but we actually have regulation coming this year, right? We're talking about Melker, MFIT, right? And this is going to establish very, very clear rules of engagement for crypto. So this might actually lead to a wave of adoption from Europe, because we're talking to institutions and they're basically looking for DeFi protocols that are compliant with Melker and MFIT, because they will very easily be able to deploy into fixed income products overnight, right? Like, how sometimes capital needs to get parked for a short amount of time and earn like a couple of interest points. So just so it doesn't lie on some account doing nothing, because you want to squeeze out everything you can. It's capital efficiency. DeFi is perfect for that, because DeFi doesn't lock up your funds, right? So this is like one of the things we're looking at with institutions right now. It's building compliant fixed income solutions for short-term capital parking, right? And because in Europe we're getting this regulation, I think some pilots will spring up, and maybe that's going to drive us forward. Like, I would be so happy, because Europe is always lagging behind on everything, right? So it would be really, really cool if we, for once, got something done first, right? Because usually it's the US. So
yeah, well, the US is lagging.
Fingers crossed.
Europe is lagging. The US is like
it's like the Western world. Like sometimes it's crazy, right? Like this lagging behind. But yeah.
Yeah,
so,
the United States is blowing my mind right now. I mean, it's incredibly slow and inefficient and just terrible big thought process.
I kind of hijacked your insurance thing there, right, with my compliance pivot. But I wanted to talk about it. I think it's.
I like the compliance pivot though. Actually, so it hasn't been published yet, but yesterday I spoke with my friend Shachaf, who is the founder of Koti in Israel, but they also do quite a bit of DeFi, and he was talking a lot about this compliance. What you're talking about right now, and it was sort of the first I heard of it, but basically creating protocols and governance and things that you can basically choose if you're a new DAO or if you're any sort of DeFi protocol, so you don't have to reinvent the wheel every single time, and so that you can basically take this pre-created solution and make sure that you're then compliant with wider regulation. Because I mean, listen, we've been parts of DAOs, right? And you are reinventing the wheel every single time.
Yeah.
You're starting from scratch. You need to vote on every single thing. You need to come up with all of your policies. There should be baselines that you can choose based on what you're building that are already regulatory compliant.
One of the biggest hurdles for us to overcome was like a real world footprint, right? Because we're DAO first. We started with a pre-DAO completely on chain. And now we're, I think we're the first DAO with an association, not a foundation, in Switzerland that is fully banked. So we're like Spool has a fully banked association in Switzerland right now, set up with the #1 law firm in Switzerland, Beankara. And we achieved that over the last year. It was a big struggle, but I think it sets a massive precedent as well, because that's what we needed, right? For dealing with institutions, we're talking to them, but they don't get DAOs, right? They want to use DeFi, but when they are engaging with like infrastructure middleware, they still want someone to talk to explain to them, okay, this is how it works. This is how you set up smart vaults, right? This is how you set up your own financial product on top of DeFi. They want someone to yell at and to hold their hand, right? And for that, having like a real world entity was a must, right? So we had to set all of that up. I don't know if it sounds like a big deal to you, but it was a big undertaking. And yeah, shout out to Simon Schaber, my colleague at Spool, who joined us as Chief Business Development Officer early in 2022, shortly after our LVP, for managing all of this, because I think it's a massive leap forward for the whole project.
Yeah, I agree. And so let's talk more about Spool. So what exactly, I mean, we've talked about this before, they've probably heard it, but give the very brief rundown on what a Spool is and how people can choose their risk level and yield and how it actually works.
Yeah, so Spool is essentially middleware / infrastructure for DeFi, right? So the idea is that we are building and sorting out adapters and handlers and also our own strategies that are yield generating based off of all the DeFi primitives out there. And we're tapping into all of that from one single master contract that constantly rebalances every deposit and every single smart vault. And smart vaults are individually created vaults or smart contracts that detail your personal rules of engagement with DeFi. So you get to pick what strategies.
I'm going to bring it up on the screen while we're talking. Sorry, because I realize I can just probably make it easier if you can see. At least this is the app. Yeah.
So like if you were to create a Spool, right, you could select all of the different strategies that we're supporting, right? And as well as a risk model that assigns risk scores to all of your strategies. And yeah, essentially by the end of it, it's a 5-step process, no coding required. You have your own personal vault. That means the strategies that you want, the risk scores that were assigned by the risk models that you chose, and then the allocation based on your risk tolerance between the different strategies. And then you have a single point of access, right? So you deposit once and your capital automatically gets split up between all of the strategies that you've chosen at your chosen allocation. And then when yields change, right, or risk scores change due to underlying circumstances, your Spool will automatically rebalance to always get you the best risk-adjusted yield, right? And we have some incentives running that get essentially allocated by Vospool, so by our governance. On eGov, I think you can see that in a couple of days, the next voting epoch comes up. And this is essentially how we're distributing tokens and governance to the community, right? It gets assigned to different vaults that, you can essentially get your Spool tokens from. And Arbitrum just launched recently.
Yeah, I was just going to click over there. But so that's why I sort of made the joke that you haven't slept, I'm assuming, because of this Arbitrum launch, right?
Yeah. So really cool thing here. We have a new user called Hawk. He just came in recently. He set up the Hawk stable Spool on Arbitrum that you saw with 120% yield. That's because he added.
That seems aggressive.
He added some incentive tokens of his own, right? So he added like some tokens of his own for people to farm with. It's only $10,000 in there right now, right? So that's why the yield is so high, because he's giving out some extra tokens. And it's quite a few tokens compared to the little TVR that is in there.
So why the move to Arbitrum? I mean, this is an expansion, not really like, it's not like you're shutting off the Ethereum project.
So
right,
so this is still just V1 of Spool, right? So this is still it's basically old code that we've repurposed for Arbitrum. Arbitrum is super important for our strategy, right? Because a lot of real yield is there and a lot of innovative yield products are on there. The community was really looking for Arbitrum based strategies. So we've ported over version 1 of Spool. It still only supports stablecoin strategies because that was the first version that we've had. Now, Arbitrum is going to become a core part of our strategy going forward. And we're also going to deploy version 2 of Spool on there. And version 2 is going to start supporting volatile assets, right? And supporting new kinds of strategies that go much deeper and offer much higher yields. So we're talking perp dex-based strategies. We're talking liquid staking derivative-based strategies and so on, right? So this is really where the commercial application lies. I see Spool V1 at this point, I see it as a battle-tested piece of code that we're using to test infrastructure and to learn off of. And this is also our experience. That's what our experience has been over the last year doing BD. It was mostly working with institutions that were going like, hey, this is a great idea, but we can't use it for this and this and this reason. And then we just went to them, met up sometimes in real life and workshop with them to what Spool or what middleware would have to look like for them to become usable. And that's what culminated in V2, which is currently being audited by Trail of Bits. And as soon as the audit is cleared, right, and we know what changes we will have to make, that's when we're going to deploy V2. And that's when we start building commercial applications on top of it, which is really what should start us, get us started on like getting revenue in, right? Like start building out performance fees for the DAO and really start going on the path of like generating our own real yield in that sense.
You talk about institutions being interested in this, obviously waiting for regulation or regulatory clarity, specifically in Europe. When we talk about institutions, there's quite a few different kinds. Are we talking about crypto native institutions like crypto hedge funds? Are we talking about banks? Are we talking about, so who are you speaking with? Not specifically, but what bucket?
So both actually. And I think this is like, I think the crypto institutions part is not what actually gets people that excited because
I agree.
Crypto institutions
That's why I asked.
talk to everyone, but there's actually real banks out there. Now we have made the very, very conscious decision to not go out and throw out fake partnerships and names and so on, because in our experience, this is usually counterproductive because it makes like institutions are skittish when it comes to crypto, right? Because crypto is full of scams and full of grifts and full of like short-term plays. And while it would probably help me so much right now if I name dropped a little bit, it will probably be bad for relationships and so on, because they would like probably feel used for marketing, and it could probably destroy some relationships that are being built up right now. So for everyone that's listening to this and calling crap right now, right? I don't know if I can swear, but
you can say shit. Yeah, you can say bullshit.
If people call bullshit here, I totally get it, right? Like I've been bamboozled many times by LARPing CEOs of projects telling me they have an Amazon partnership because they're using AWS, right? I've been there, so just wait, right? In that sense, like if you want to see what's happening, just follow us on socials, and we're going to talk about it as soon as it's ready. But another thing that I could talk about, for example, is custodians, right? So
please,
we need to, the DeFi needs to be accessible through not just MetaMask, right? Also through custodied funds, right? So we're working with the prime custodians to build out apps native to the custody apps, right? So if you have funds custodied with a custody provider, you could go through the Spool process, create the ideal diversified yield strategy that you're looking for, and then deposit directly through your favorite custodian. Why do I say that so generally? Because I'm pretty confident we're covering all the favorite custodians of people out there, and we're going to talk about that more soon. I think now that V2 is finally done, we're going to go out there and make some waves this year, right?
That's such an interesting point, because You can't really have an institutional conversation and then expect that they're going to move a bunch of coins around in DeFi. I mean, in MetaMask, right?
Yeah, exactly. Or their own ledger even, right? Because it's other people's funds.
That was the funniest, to me, that was the funniest narrative looking back on 2017, 2018, that the institutions are coming and we didn't even have custodians or any infrastructure. Yeah. Like the notion that some huge company or government or endowment was going to go buy a multi-sig and hope for the best, and that's the way they were going to custody, and that could never get past the risk managers. We were so stupid.
Yeah.
So,
but we've all grown.
But now you're saying that the infrastructure exists or will exist that actually allow them to do this in a compliant manner. It's very hard to speak to whether they will, what the market will be like at that time.
So
but you can confidently say that the tools are either built or
they're
being built here.
They're built.
Yeah, that's a huge difference. Is there any concern about the regulators and what they're saying about custody and what they're saying about securities? I mean, obviously, Gary Gensler would open this and be like, everything here is a security.
Yes,
right?
obviously, right? Like he would call, like if I posted the wrong emoji in the chat right now, I'd probably go to jail or something, right?
Right. No rockets, dude.
No rockets. No rockets. But in general, right? Like the thing about regulation is you have to be proactive as a protocol, right? Because we're not getting any gifts in crypto when it comes to regulation. People will use utmost scrutiny. So what we're doing is we're actively, because we have this association now and we have proper banking, we're now talking to law firms to actually get proper opinions, right? Like proper opinions on the use cases that we're proposing. And we also have a couple more crypto-focused joint ventures planned. This means actual partnerships, right? It's not a partnership for me to say I'm using Aave because I'm depositing into Aave contracts. That's not a partnership with Aave or with Curve, right? Real partnerships in DeFi are or for middleware are building products, right? Building our products together, using your infrastructure. And that's what I'm talking about when I say joint ventures, right? So there's really cool things coming, for example, a flexible liquid staking index, right? So we know Index Coop has a staking index. I think it's really important to have these indexes, right? Because it allows you to spread your risk across different liquid staking solutions. We're going to see more liquid staking solutions in the future because decentralization kind of requires it. But users want to spread out the risk across these protocols. But at the same time, you're going to have different levels of trust for each of these protocols, right? So you want to be able to exclude some of them. Like I might trust different liquid staking providers than you, for example. So if we were building our own perfect indices, they would be looking slightly differently because you might be including curve strategies based on these liquid staking derivatives, right? Like liquidity pools. I might not. I want to just be exposed to pure liquid staking. All of these things, right? So we're building out a joint venture that will allow users in a no-code fashion deploy liquid staking, right? And deploy their own sort of liquid staking portfolio while beating average staking rewards, right? While still outperforming regular staking. So that's going to be pretty interesting. And yeah, that's one example of what we're going to do in terms of commercial applications.
Perfect. I think the summary is that there is safe yield if you understand the risk, but it's still primarily for crypto natives, and we're building it out to expand.
I mean, we need applications, simple to use apps and financial services, right? People want to be told what to do with their funds. They don't want to be their own asset managers. They want to rely on professionals. And within crypto, we have the cool advantage that we can build out smart automated professionals, right? It's like yield ETFs, for example, that automatically rebalance. That's like someone telling you what to do, but it's actually code, right? It's smartly built products on solid infrastructure.
Well, then maybe the next iteration will be very intelligent AI balancing our spools.
That's the next meme, right? AI rebalancing our DeFi indices or whatever.
I think it's coming. So listen, man, where can everybody follow you? Check this out. Unfortunately, I have another meeting in approximately 3 minutes, or we could talk about AI probably for the next 5 hours. And also, I think you guys in the Spool, I think I saw that you guys are having a chat about this in the Spool Discord, right?
Yeah.
So anyone who's over there. Yeah.
Look, I'm going over to the Spool Discord now. If you want to follow me, Twitter at Spoolify, or my Twitter at DJ Spoolboy, right?
It's like my favorite Twitter name.
Thanks.
DJ
It's actually
Spoolboy.
based on a real DJ called DJ Poolboy, who's pretty good. So check him out if you want to find some new music.
Awesome.
I'm a fan,
yeah.
So.
Perfect. So thank you very much, man. I'm really interested, obviously, as an investor, as a participant, to see how this all plays out. I think it's just very important that people understand the risk and that everything is transparent, and then people can make their own decisions.
Always do your own research, guys. Never listen to talking heads on YouTube. No offense, Scott.
I am literally the talking head on YouTube, and I still take no offense to that in any way, shape, or
I meant
form.
myself more than anything, right?
Yeah, well, we're all there. So everybody, tomorrow, of course, we have the roundtable. It's going to be somewhat epic. We'll probably touch on a lot of the topics that we talked about here today, to be quite honest, especially also talking about ETF. We have Mark Yusko, Dan Gunsberg from Hero, Steve McClurg from Valkyrie, and David Young from Coinbase. So that should be a pretty epic conversation. Phil, man, always a pleasure. Go back to sleep, I guess.
I'm not going to sleep. I'm going to Discord and then I have a Twitter Spaces. We're on.
Okay, well, go to Discord, and then I'll meet you on Twitter Spaces then, okay?
See you soon. Thanks,
All right,
Scott.
man.
Thanks
Thank
for
you very
having me.
much,
Bye-bye.
guys. See you all tomorrow. Peace.
That's dope.